Welcome everyone to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money color commentator. On today's show, unwittingly dragging liability into your plan. Part 3 of our series on asset and wealth preservation for business owners with Ike Devji, attorney and asset protection specialist. Welcome to our third segment, Ike.
Thank you, Steve. It's good to be here.
Boy, I threw that word, my adjective in there, unwittingly. I read that whole section on what we're talking about here, about putting a square peg in a round hole, and I'm thinking, I'm using the tool. You told me to use the tool, and I'm using it inappropriately. Unwittingly, unknowingly, clients, consumers, small business owners that watch our show, they always go, but I thought I did what I was supposed to do. So let's talk about using the right tool with the right scenario, because that's our problem in this segment. I want to address that because that's a problem.
It's a big problem, and I'm glad you brought that up. If we look at the range of tools that are available to business owners or to the American public at large, and we've talked about some of the most basic ones, trusts, partnerships, LLCs, corporations, things like that. Each of those is appropriate for different kinds of assets. And there are a couple of basic rules that we try and follow. And, a friend of mine who's an expert in this area, also Jay Atkinson, also always says general rules are generally inapplicable, right? So I think that's a great phrase. But if we talk about things, we know that we should be using personal tools for personal assets and business tools for business assets. That's one really basic thing. And we're going to talk a little bit about those distinctions. But if a tool that's objectively a good tool for the right purpose, like maybe we have an LLC or a trust or a partnership, just because you have one of those tools doesn't mean it's a one-size-fit-all, right? So for instance, an LLC is a perfect tool to hold a piece of investment real estate. Maybe it's the building your business occupies. Maybe it's your rental home. Maybe it is a strip mall that you lease to others. Maybe it's an apartment building. An LLC, as an example, might be a perfect wrapper for that. You would not put your personal residence that you live in an LLC because there's no legitimate business purpose for doing so. Unless you're going to pay that LLC commercially reasonable rent for occupying your own home and run it like a real, honest-to-God separate business that maintains its own taxes and accounts and expenses, it's not an appropriate tool for that asset.
Do you see that kind of commingling all the time?
We see it
personal and business in one LLC?
We see it all the time, and we see two different things. So what you just said is actually two distinct mistakes. One mistake would be taking your home and putting it in the same LLC as a piece of commercial property to try and protect your home, as one common mistake that people might make. And then if there's a slip and fall at your strip mall or your restaurant building that you've got leased out to somebody, that LLC is going to get sued, and that LLC owns two distinct assets, the building itself and your house that had nothing to do with it. So we talked about this earlier. We talked about too many eggs in one basket as one theory. So this is very closely related, is not using the right tool for the right job. Similarly, somebody might set up a trust and use it again like a trash can and put lots of different assets in it. Maybe they put their home in the trust, and maybe that was the right place for their personal residence that they actually occupy to be, but they shouldn't put their car in there as well. Why? Because if they kill someone or injure someone with the car, the owner of the car is the trust that owns your home that you put in there to protect it from. Does that make sense the way I'm saying that?
Yes, but you're making such a distinction that most people don't get. They have their attorneys, they're doing estate plan, they're doing business defense, but they don't think in these terms of ownership, bifurcating their personal life from their business life. I mean, there's a lot of things you're bringing up here that I'm sure our audience is going, I'm sorry, Ike, I did not know that.
Well, and that's the core of asset protection planning or wealth preservation planning or whatever you want to call it. It's just good business planning, is making those assets legally distinct and dividing those boxes into reasonable amounts of risk, right? So for instance, if we have somebody who's got $1 million worth of real estate, and that really comprises the majority of their net worth, and they've worked really hard and they went out and they saved it, maybe they bought four or five rental homes for a couple $100,000 each. Should all of those be in one basket? Probably not. We should probably divide those so that if we have an exposure at one, we're not losing all of them. So we have to make sure that we're using the tool the right way. Then we need to make sure we're also using the right tool. So, for instance, as we said, you don't put your the house you and your family live in into an LLC. It will almost never protect you adequately. You don't put the vehicles you drive into an LLC. And this is another common thing that we see people doing, is they think that if they create an LLC and have that LLC own or lease the vehicles that they and their spouse and their children drive, it's going to protect them from that personal liability. Again, if you're not running it like a real business and paying that LLC commercially reasonable lease fees for all of those vehicles and running it like a real business, a third-party business, there is no legitimate business purpose, and it's not going to be defensible. So we sometimes see people attributing powers to a legal entity that don't exist, or we see people undoing the powers that a legal entity has by using the wrong tool for the wrong job.
Again, you can go out to Ike's site. It's proassetprotection.com. He's got a lot of great stuff out there. I want to shift gears and talk about these. People don't do dumb things on purpose. We're dragging liability into our plan. We didn't know that. You're talking about some of this now. I'm trying to think about, for the normal person, he says, I understand an LLC. There's reasons to have one. There's reasons to have an S Corp. There's reasons. Most people that deal with this kind of language, or C Corp, deal with it on the tax issue. They're just focused on which one gives me the better tax protection. But some of that tax is not incorporating what you're talking about, that brings in these exposures and liabilities. That's the thing that you're great on, and that's why I wanted you in on this show, because I see small business owners exposing themselves needlessly, unwittingly.
Well, I agree with you 100%, Steve. And when you talk about dragging liability into your plan, let's talk about maybe a really common example. I think probably the single most common example is leasing your vehicle through your business because your CPA rightly told you that you would get a tax deduction for doing so. So for the next 20 seconds, I want you to pretend to be the most obnoxious personal injury attorney that you see advertising on TV every night. Would you rather have your client killed or injured, if you're that attorney who wants to sue somebody and make a recovery? Would you rather have that person killed or injured by Steve Savant, Dr. Savant, or Savant Plastic Surgery of North Scottsdale?
I think I'd like it on the personal side, right? I mean, you wouldn't want them on the business side, would you?
Well, if you're a lawyer, you get very excited if a business owns that vehicle because that's the deep-pocketed corporate defendant. So what we see in that situation, we're talking about dragging liability back into a plan, is that you took an activity, driving your personal vehicle that has nothing to do with your business, and you lease that vehicle through your business, link those two things together. So now, if you hit me with your car, I'm not just suing Steve, I'm suing Steve's company. And why did we kill the golden goose, your business that provides all of the wealth that you work so hard for, by hitching that vehicle to it? That vehicle never should have been attached to that business in the first place.
In defense of my stupidity, okay, I would say because my CPA told me to get the tax deduction through my company.
Your CPA is right about the tax deduction, but your CPA doesn't do what I do and doesn't have that concern. That's not a criticism of the CPA. Sure. The CPA is right on the tax issue. Maybe another interesting way to approach that would simply be to take a car allowance, where the company gives you the money and you go out and get your vehicle or do whatever you want. And obviously, your viewers should talk to their CPA about the difference. But from our perspective, leasing a vehicle through a business that you own is always the wrong move and drags that liability back in. And there are many other ways to drag liability in, right? Mixing a high-risk property or a high-risk asset with a low-risk asset. So for instance, would you take the same LLC, for instance, that held your rental home and put an investment account in that LLC? Well, of course not, because you're dragging the liability of owning a property, which is a very high level of liability, into the liability sphere of owning an investment account, which is completely passive and generates almost no liability. So you have risked the investment account by putting it in the same box as the rental house.
But I could see the normal consumer, business owner, small business owner saying, my rental property is income and it's an asset, a financial asset. Oh, and so is my portfolio, my personal portfolio. And him thinking in his mind, or her, bringing this under one LLC that deals with assets that I have sounds logical.
I agree that both of those assets should be protected, and neither should be in your own name. But unfortunately, we can't use the same tools for high-risk assets and low-risk assets as just one example.
Well, don't forget to watch part 4 of our series on asset and wealth preservation for business owners using unproven or poorly structured plans that can really cost you. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the business.